Awesome. Well, good morning, everybody. Glad to be here. It's February 13th. This is our special meeting of the MCE Technical Committee, and we'll get this meeting started exactly at 10 a.m. The first item on the agenda is the roll call and quorum, so I'll ask the clerk to call roll.
Okay. Hercules,
Here.
Lafayette,
Here.
Clarksburg, Pinole,
Here.
Pleasant Hill, Richmond, Vallejo. Quorum established.
Right, thank you so much. The next item on the agenda is our board announcements. Do any members of the board have announcements?
Nope.
Right, not seeing any here in Concord. I don't see any board members in Zumberfell. I know if anyone else has any announcements, so we'll keep it moving. The item on their agenda that probably will take the most time today is going to be our MCE rate reduction proposals. I'll bring it back to staff for the presentation.
Thank you so much. And do we have Maida and Cal on the line?
Yeah.
Looks like they're on.
Great.
Good morning, everyone. I'll just give a moment for Myra to join. Maybe she's just kind of getting into panelist mode. I messaged her. I know she's under the weather.
Cal, I think you could kick it off if you're comfortable.
Gotcha. Yeah, Myra says she's not able to log in yet, so I can start the presentation.
Thank you.
Thank you for joining. Good morning, everyone. We'll go through rate reduction proposals. I know we went through in XCOM, TechCom, to some extent in TechCom, and we also had workshop. So another opportunity for us to get good feedback from the team. Next slide, please. Yeah. So before getting into rate settings for the upcoming year, just grounding us in the principles. I know we went in details in our 6 core principles. I think first and foremost is revenue sufficiency. As any good business, you just have to have enough revenue to run a successful long-term business. I think if I can ground us, I think that's our one of the major principles. On top of it, we have stability. We don't want frequent rate changes. Obviously, we want to compete with PG&E by offering lower and stable rates, and how efficient our rates are in terms of time of use. Encouraging customers to use electricity when periods of less grid during non-peak hours, to reduce stress on the grid. And equity, how does our rates differentiate between reflect cost of service, basically, and then clarity. Our rates, are they simple for customers to understand so that they can adjust their behavior to make an impact to their bill or reduce their bill? Okay, next slide, please. Yeah, once we look at the principles, yeah, we can looking at our reserve and liquidity policy. I see Myra join. Hi, Myra. Probably I'll just
Hi, Kyle. Hi, everyone. I'm sorry. I was not being able to log into the Zoom earlier today. I can give more color to this slide, but I think we've went through this slide and this presentation a few times, and I'm just gonna try to go run it quickly so we have more time for questions in the end. So the important thing of this slide here is that 60% of our annual energy and operating expenses, that's our reserves, and this is our board-approved reserve, and our liquidity goals are for 240 days cash on hand. So on the first bar, we have 24-25 results where we did not hit the 240 liquidity goals. We were at 218. And the projections for 25-27 is for us to hit at 274, our liquidity goals. And our reserves on 24-25, they were at 84%. And the projection for this current fiscal year is to get to hopefully 109, hitting our both reserves and liquidity policy. Next slide, please. I am going to ask Jamie Tuckey to join us on this, to present this slide to us.
Thank you, Maida. Hi, good morning, everyone. I'm happy to go over this slide with you all. If you joined our workshop, this was a slide that we discussed, and we got some great feedback from our board that we have included in this updated slide, but we want to talk about MCE's value proposition and why customers choose MCE. Of course, rates is an important part of that, but also what we're offering overall to our customers is something we can't lose sight of. So MCE offers cleaner energy, local control, and community benefits, and we do it all with stable and competitive rates. And as you know, for most of our history, our cost of service has actually been less than PG&E. We've also always had cleaner energy. We provide significantly more renewable energy than PG&E. The 2024 power content label shows MCE at 69% renewable versus 23% renewable for PG&E. And we also have a lower emissions factor. We are also a community first, not-for-profit, and I love this because it means that a portion of what you're spending on your electricity bill as an MCE customer is going back into your own community instead of into shareholder profits. We offer bill discounts to our customers, customer rebates for electric vehicles, upgrading their home or business with energy efficiency upgrades, clean energy projects. We have our local solar projects. We've got a local biogas project, and creating jobs and workforce training for people in our communities who are living and working here and want to enter the green economy. We're also governed by your board of locally elected officials, and customers have an opportunity to really weigh in and provide feedback into the programs and services that we offer in a way that just isn't possible with PG&E. And then, of course, what we're talking about today are the competitive and stable rates. We've historically only changed our rates once a year or even less. The last time we changed our rates was in 2023 in terms of a broad rate change that impacted all of our customers. We also offer income qualified discounts that are on top of what's offered by PG&E, like the MCE Cares credit for our income qualified homes and small businesses, and our myriad of customer programs. Thanks again for your feedback at the workshop and helping us to fine-tune this value proposition. I'm happy to answer any questions or take any other feedback on this. And if not, hand it back to Maida and Cal.
Great update. This is very nice. It's very smooth. Thank you very much. That was great. This is a great slide.
Thank you for your feedback. Next slide.
Second, thank you, Jamie, for that. Thank you, Myra. Again, nice segue into historical generate plus PCIA comparison. As Jamie noted, historically, the value proposition, along with cleaner, greener rates and community involvement, is also stable and lower rates. I think this chart kind of illustrates that point. Again, we have seen this chart numerous times. What we have is MCE's generation plus PCIA rate in the green line, and yellow line shows PG&E's generation plus PCIA from 2013 to 2025. And on the secondary axis, on the right axis, is the participation rate, which are in bars representing the percentages. We can see historically MCE has been cheaper or stable. I think periods of time where we are expensive than PG&E, but if you look at PG&E, they are volatile, especially in the recent 5-6 years. And the point I think we were making earlier too was if you look at in 2021, MCE rates were higher than PG&Es. I think the participation rate has no impact on it. It's still at 87%. In fact, went a little bit higher than 2020. But then in 2022, PG&E rates were higher than MCEs. But still, our participation rates in theory should have increased. It has not. And then again, going back to 2024, it's the same kind of chart. You see 86% participation rate. And in 2025, we are slightly higher than PG&Es. Again, no impact on participation rate. So goes to show there is some sort of inelasticity in customer participation, even accounting for the price swings in both PG&E and MCE's favor. Going into next slide. And there were quite a few questions on customer elasticity, participation rate, how that would be impacted with price. I think we got this slide. We showed it in the budget workshop a couple of days back. Again, punchline, I think despite periods of higher rates, customer participation remains strong. Again, just to have a summary of our recent, participation rate, MCE generation plus PCIA has been higher than PG&Es from June 2025. Participation, again, is at all-time high, a little bit over 87%. And we have record number of customers over 600,000 accounts. Again, opt-outs continue to remain historically low. And the last one, there's another factor which is playing in, probably making customer participation inelastic, is the transition bundle service. So customers who opt out must decide to stay with MCE for 6 months, or if they want to immediately transition to PG&E, they would be put on transition bundle service. And that rate is very volatile. It's tied to KISO market, and it's often 2 to 3 times higher than standard rate. Right. So key takeaway, what we see is customers seem to appreciate our value, from the value proposition slide, long-term stability, sustainability, and program benefits. Not really looking at short-term price differences. Again, affordability remains a core priority for us. It's supported by several bill discounts and customer programs for financially vulnerable customers. Okay, going into next slide. Again, one more new slide we added. I know it's not in the packet. Just want to call that out. We got feedback from the budget workshop too. How is our customers mix looking like? Right? If you look by customer count by class of 600,000 accounts, I think over 90% are residential and roughly 10% is commercial. So predominantly residential base. But if you look at load consumption, it's actually split 50-50. So commercial, even though they account for only 10% of our accounts, they actually make up 50% of our load. Residential, even though bulk of our accounts, only makes up 50% of our other 50% of our load. I think revenue breakdown follows load breakdown, so roughly 50-50. And then one more dimension to look at is the participation rate. Again, breaking out for residential and commercial customers. So in residential space, our participation rate is 87%. And in commercial space, it's a little bit higher. It's over 90%. But net, when you take the weights, it's coming around 87%. That's the overall participation rates we've been showing.
Now, just real quick on that, that's a new slide. I feel like, did you include the Caltrans partnership in that as well?
Caltrans in this one, maybe
Addition to the bridges, or of the bridges, would those be included in that?
I think it would be, Director. I mean, I don't know if
Yes.
Zay or anyone from customer operations.
It's probably there, yes.
Good morning, everyone. Yeah, it is inclusive of the Caltrans project.
Thanks there.
Certainly.
Yeah. Again, this slide was, I know it's not in the packet, something we added based on the feedback. So
Thank you.
Yeah,
Thank you.
it's really interesting.
It's really
Really
interesting. Sure.
So the 13% that don't participate in MCE, since that doesn't appear to be cost driven, do we know the reasons why they opt out of MCE?
Yeah, and it's actually a construct that's not necessarily opting out of MCE. When we look at the history, especially the expanded history of our participation and our customer engagement, a lot of the 13% that we see today are still carryovers from our very first launch in the county of Marin. So when we look at each of our different counties, we can see as time goes and as the brand and knowledge and understanding of the differences between MCE and PG&E, those participation rates continue to change. And the positive side is that we're seeing a trend with improved participation in the county of Marin and the cities there. So we'll keep with that track. And that's one of the things that I was talking about at the workshop the other day is that yes, we do have opt-outs. My team is there to help educate customers and explain the differences. And we've been successful in retaining those customers as they call in. And that's helped us to maintain our participation and even grow our participation, even in years where we're not having enrollments. The total amount of opt-outs is not equal to these percentages. And then the other part of it is that some customers, when they originally opt out, that opt out carries with them. So they could opt out and then move to another location, and that opt out carries with them. So there's that's where some of that inelasticity comes from. And then the third part of it is some corporations decide that they uniformly are not going to join a CCA. And this also includes any customers that decide that they want to do direct access. So it's very large corporations where they aren't receiving their generation from either us or PG&E.
Thank you. It's good
Certainly.
information.
I'd love to add on just a bit. Thank you for all that information, Zay. It's super helpful. I just want to add that when customers opt out, we do ask them why they're opting out, and they don't always tell us, but we've asked them that since day one when we launched in 2010. And over the years, we tend to see the same top three reasons. Those top three might vary a little bit, but the three reasons are one, that they don't like that MCE is an opt-out business where they are automatically enrolled unless they opt out. So for some folks, that really rubs them the wrong way, and they just say, I don't want to be a part of it because of that. This one of the other top three reasons is because they don't trust government agencies. So they don't like the fact that we're a local government. And the third, and these top three reasons are because of costs. And even when we are less expensive, customers will cite costs. We will tell them we're less expensive. We'll give them a cost comparison, but there are at times still a lack of trust that we're not actually less expensive. So just wanted to share those top three reasons that have remained pretty static historically.
So and through the chair, if I may, so you were saying that one of them, the first bullet, that they don't like that they can opt out, so they want to just be forced.
They don't like that they're automatically enrolled, which is funny because they're automatically enrolled with PG&E, right? And because of MCE, they have a choice where they had none. But there is still this sentiment from some people when we enroll a new community and we send out notices saying you're going to start getting MCE service. Some folks feel really frustrated by the fact that that decision is made for them, that they'll automatically start with MCE. And so they say, no, I'm not doing that and I want to opt out.
So they're just being rebels.
Yes. You can
Maybe do something.
You can say
government.
sure.
May I, through the chair, may I ask another question of Zay?
And welcome.
Zay, do we have a breakdown by county or by area of where that 13% is, and then broken down between residential and commercial?
Yes, we
Because I
do.
would love to go and knock on my people's doors.
Yes, we
Especially
do have that.
commercial.
Yeah, we do have that available. We have it by community as well as by county.
Okay, and then do we have a comparison somewhere of rates comparing us against other agencies, not just PG&E? So whatever decision we make on the rates, can we compare and say, look, MCE is still better, or maybe higher, might be lower, might be something compared to SMUD in Sacramento, compared to, I don't know, all the agencies that provide power. Right, so we're able to compare, because we're gonna, regardless of where, if we decide to raise the rates or keep the rates, I think we should still have something that tells us a story of where we are and then maybe, or where we wanna go. So I don't know, we have that available somewhere. That we
We-
might be able to produce into
Yeah.
maybe a slide that when we come to the full board, being able to show them, might just be able to say, here's where we are.
Yeah, we'd be able to produce something in that fashion. One item that I'd want to mention and that we would have to figure out how we would attach that and footnote it is that we do have CCAs who are price bound, meaning that within their JPA, within their launch, they have promised to be less than PG&E in all circumstances. So rate is not always going to be apples to apples in that fashion, but we can definitely pull everything together.
Thank you. And even if we can have a little asterisk to those, because that's important to know as well, because you could only be the cheapest for so long until you're no longer competitive. And then future ratepayers are going to most likely have to make up the cost. We see that in other public agencies where they haven't increased the rates, because and they go out to the people saying, vote for me again, I've never increased your rates, and then infrastructure fails. And then they get a 300% increase in their rates all of a sudden. So cheaper,
Exactly.
not necessarily better, and I think that's part of the story. Is how do we remain sustainable? Again, not knowing where we're going to vote on the rate, but if we increase it or keep it or whatever, long-term sustainability of the agency is not
Yeah.
just comparison.
And also the value, the inherent value with
And
that.
the value, yeah.
And recognizing what Jamie had mentioned, we have the three reasons, but the first reason and the third reason are actually combined. A lot of customers feel that they are upset about being enrolled because they see an additional line item on their bill, and they said, "Hey, I didn't allow for you to do that." And we can say as many times as we want to say that that additional line item is not additional. It's a new line item, but the cost is just shifted from one line item to the next. But the trust isn't there, the understanding isn't there. So it's a combination of I didn't sign up for this and I don't want additional cost, even if that additional cost is a savings.
And do we have these 3 points broken down by area? Because that might be interesting too. Just, there's areas in our service area that might lean more towards less government. And then just that way we kind of know how to target the communication and explaining. And if we can kind of see, Hercules is our newest city, right? Are we getting any pushback from them now to learn?
Yep.
Or are we getting it just from older groups? Any other data, I think, will help us figure out the communication and then how to target. Everyone's gonna need a little bit of target.
Yeah, we actually recognize that within our service center and call center. And my team has talking points to the value differentials in different regions, areas, communities, and also the understanding of those communities so that they can properly communicate, educate, and listen to the concerns of each individual customer in each individual area.
And kind of a side note to what you're saying there, the bill comes in from PG&E. And I'm assuming that's a paper bill, because that's I don't know that when I've last seen a paper bill. Everything's online, so I'm assuming it's gonna be older leaning individuals that are still getting paper. So is there a way that MCE could send a bill out with our name on it instead of PG&E's and have PG&E be a line item versus we are a line item?
To take a big regulatory shift,
Okay,
and is not something that's available at this time.
okay, thank you.
In the statute.
Is that, okay, so that's.
Statute, yeah.
Okay, thank you.
All right, any other questions? No.
Okay.
Go ahead, Cal.
Okay. Yeah. Moving. I mean, if no questions, we can go to next slide. Okay. Just I know we touched on this point around inelasticity. It's something called transition bundle service. It's PG&E switching limits. Again, just to going back to the board, I think customers opting out of CCA really have two choices. One, they can give a 6 months notice and stay with the CCA for that period and then transition to PG&E. Then they get the bundle rates. But they can also choose to return to PG&E immediately. If they opt out without giving that 6 months notice, those customers would be put on PG&E's transition bundle service for 6 months. Under TBS, the rate schedule is TBCC, transition bundle commodity cost, and that particular rate schedule is highly volatile. And it's costly too, often 2 to 3 times of standard rates. It's actually tied to CAISO market, as I said earlier, and it fluctuates weekly. And the range, we look at it, it's typically in the recent years, 14 cents to 30 cents per kilowatt hour. Just to put things in perspective, current rates are roughly 12 to 15 cents per kilowatt hour. So you can see it's not only volatile TBCC, but it can be expensive too. And what's more is those customers get to take their original PCIA vintage. They don't get the bundle PCIA. So after 6 months, customers move to bundle generation rate plus bundle PCIA, followed by a 12-month IOU lock-in. I think 12 months count from the day they give notice or they move back to PG&E. So that's a 12-month lock-in. Any questions on this slide?
Nothing in Concord. Are there, Director Zepeda, do you have any questions?
No, thank you.
Okay. So moving on to next slide. Okay. Again, getting all those together, our principles, what's a value proposition we bring back to the table, time for us to look, when we try to look at for the upcoming fiscal year, how should we set our rates? Again, I think simple answer is we got to balance cost with competitiveness and long-term customer retention. There's tension, obviously, there's cost on one side. You want to manage your costs, but also need to set rates where cost should actually dictate our floor, where we, keep our rates. All right. Anything lower than cost-based rates, it's like not a sustainable business. So bare minimum, I think that should be our floor. True cost should set a rate floor. And then, that obviously that supports long-term financial stability. We should also align with our reserve policy. So that's on one side. The other side, we see the competitiveness, retention. Again, we touched upon value proposition. Retention is not just influenced by price. It's actually, there's more to it, right? It's how cleaner we are, how greener we are, what programs we offer to the customers, and historically how we've been doing on stability, and are we offering lower rates? And more importantly, for a customer to make a decision, I think it's a long-term value proposition too. How are we looking in the future, right? Are we going to provide cleaner, greener, or competitive rates, right? I think they all come together. So I think for us, when we look at how to set rates, MC must balance cost recovery while maintaining compelling customer value proposition across several dimensions, including price, sustainability, stability, programs, and long-term certainty. I think that's how we thought about it, and that's how we set our rates going into next slides. Okay. Again, I know we went through this before, what rate relief tools we have. So knowing that PG&E dropped the rates, we have to decrease the rates. So what tools we have in our arsenal to give some relief to our customers. The first one is the obvious one, rate reduction headroom, roughly 90 million. Basically, what it's saying is we have current rates higher than our cost-based rates. So if we were to drop it to cost, so we would kind of forego 89 million. So that's the first option, an obvious option. And the second one is we have operating reserve fund, 70 million, and we can use those funds to provide, rate relief to our customers. So once we exhaust those two big buckets, now we're getting into reserves. In reserves-backed funding, as we labeled it here, coming from reserves. So we can tap into reserves if we choose to, but we have, our policy says 240 days of liquidity on hand, 60% reserves. So if you want to go to the just hit those targets, we can unlock roughly 24 to 36 million. So that wouldn't affect our reserve and liquidity targets. And finally, again, not in line with our clean, green sustainability goals, but if we choose to, we can reduce our clean energy procurement. That can unlock up to 17 million. And, so in total, when we look at total relief, we are looking at a little bit over 200 million. Right. Any questions on this slide?
Yeah, it seems like a couple, Director Bailey.
Yeah.
I think like Director McCormick has a question.
Yeah.
No,
Seems like we're voting on that.
Yeah. All right, I'll try and ask quickly. I think I read this differently both times when I read the report. So the reserve back funding, that's rate reserve, sort of a funding for smoothing rates, or is that our actual reserves for the org?
Actual reserves we have to support our operations, I guess. Yeah. So operating reserve fund is 70 million. So on top of it, these are all additive reserves. Then we tap into reserves without looking at operating reserve fund. But the floor is the targets. So we have a little bit more than what we need in the targets. So that money is roughly 24 to 36 million. I hope that makes sense.
I'm going to ask a follow-up to make sure I comprehended that. So the operating reserve fund is for rate smoothing, not impacting the entire org, just the money we've set aside. Is that right?
That's the money we set aside, but that is used in liquidity. Obviously, we have liquid that money. So there are two metrics for us. One is reserves, one is liquidity. In liquidity calculation, I think operating reserve fund is taken into account, but that money is set aside to do
this purpose.
Yeah.
Understood. Okay, thank you very much for that. Appreciate it. Thank you, Chair.
Yeah, so I guess the way I would look at it is, all right, that 70 million fund, I mean, its purpose is actually what we're talking about.
Exactly.
I mean, that's kind of where it's like, that's the reason it's there, right? Is to provide this kind of temporary targeted rate relief, right?
Yeah.
Versus the other bits are, I mean, it's all somewhat arbitrary buckets we're putting extra money in, but the going into our other reserves, just it feels like that's more for something a little more catastrophic than voluntarily suggest, indicating whatever lower rate. So I do really view the uses of those as very, very distinct. This is great. Thank you.
Yeah.
One important distinction is that the operating reserve fund, that's deferred income from previous years. So that 70 million from we started building that in 2019, and that's deferred income. So when so we would use that so we wouldn't have a negative year. So we would actually realize some of that income in the year that we are proposing to have it. That's the difference. That's the fundamental accounting difference from the ORF to the reserve back funding.
That's a very good point. And actually, that's a very, very good distinction. Thank you.
You're welcome.
All right. Can we move on to next slide, please? Okay. So once we look at how much of part of money we can really get to use it towards reducing our rates, look at 5 options. Again, kind of bookends for us to look at, looking at residential ETOUC plan, which is the most popular plan. So option one, says 1.73 cents per kilowatt hour. It's a reduction from our current rates to cost-based rates. So hence under recovery is 0. So basically a break-even point. We would run a business without making any money, but we're not losing any money too. Again, I think that's in the second column. Third column shows under recovery. Maybe I'll run through the table. And if there is any under recovery, how that is addressed is in the fourth column. And fifth column shows a typical monthly bill impact without PCI, looking at PCIA, purely comparing generation. And the last column shows bill impact, monthly bill impact, by taking PCIA into account, along with generation rates. And the comparison is obviously MCE and PG&E. Okay. Going back to option one, it's a break-even point. Just about recovering our cost, hence the under recovery is 0. Again, in that instance, we would be slightly above bundle customers without BCIA, roughly $1, $22 if you take PCIA. The swing is really $21, as you see. And that's the range we are playing with to make a dent in the options further down. So option 2, a little bit over 2 cents. In that case, if we reduce our rates by a little bit over 2 cents, we would be under recovering by 17 million. So basically, we would be running at a loss, but we do have operating reserve fund up to 70 million, so we can tap into it. So partial ORF, as you can see, bill impact, we write about parity on generation rates with PG&E. But if you take PCIA into account, in this instance, it would be over $21 above bundle customers, right? So likewise, in option 3, if we drop by additional 3 cents, we would almost exhaust our operating reserve fund. Basically, we would be running a deficit of 67 million, all comes from operating reserve fund. In that instance, bill impact purely on generation, we would be $4 below bundled customers, but $17 above if we take PCIA into account. And then fourth one is another break-even point, where we would exhaust. We would be, again, running a deficit of 94 million. If we drop by 3.5 cents, we'd use up all operating reserve fund plus reserve back funding, which is roughly 24 to 36 million, which we showed in the earlier slide. So basically, we are tapping out all ORF, any excess reserves on top of our targets. Then we would be giving a relief. We would be lower by $7 if we don't take PCIA, but with PCIA above by 14. And the last option really is, I think we can drop our generation rates by 4 cents, running a deficit of 119 million. Again, we use up all ORF, use up all the excess reserves on top of our targets. Plus, I think what it needs is, I think, lowering our clean energy procurement target. And in this option, the assumption is we would go to, I think, bare minimum compliance requirement for meeting our RPS clean energy goals, right? In that instance, I think that's a maximum dent we can make into PCIA. So we're purely looking at generation, we would be cheaper by $9. But if we look at with PCIA, we would still be higher by $12. I'll pause there to see if any questions.
Sure, Director Bailey.
Yeah, and this may have just been discussed at the budget meeting, and I apologize I was not present for that. I think the video is coming soon, I think is what I heard. But I had a question on the bottom of the, sort of the legend down there. It says these are residential rates. So my question is the total cost of 17 million, is that across the entire, all of our customers, or is that just the impact on residential, just the residential customer benefit? just use option 2 as an example. We see 17 million there. Again, is that number just residential, or is it double that when we include the commercial?
Good question. It includes everything. So we kind of showing the rates representative from, picking one rate, ETUOC, which is most popular rate, but the dollar impact is across rate schedules. But the under recovery, takes everything into account, right? If you were to drop similarly 2 cents for not exactly 2.05, that's on ETOUC, but other rates similar in that range, other rate schedules. But overall, under recovery would be 17 million in option 2. That makes sense.
Can I ask one more question? It's a follow-up question that is that we do have different rates for commercial and for, I think I remember. So if we did it for just residential, first of all, would that be wise from staff's perspective? And then will we get a substantially different number? Because in my mind, it would be half, because half of our sales of energy go to residential customers. I think it's what the last chart showed. So can you clarify or give a little bit of information on that?
So the way we're looking at it is we have pot of money. The rates are different, but they're not that different. For example, I think residential may be 12, there's another rate schedule, maybe 13, maybe I know for a large business, maybe roughly 10. So they're right around that, right around 12. If you look at it, 12 to 14 right now in that range. And we want to drop the rates proportionally for every rate. Like if you want to drop by 12%, 14%, 21%, that's one question. The other question is, do you want to give some relief into PCIA? Because PCIA is roughly similar again for every rate schedule. So the consumption is really where the difference is. For a residential, consumption is 438 kilowatt hours. For a small business, maybe it's over 1,000. For a large customer, really large customer, maybe it's almost 200,000 kilowatt hour. So the consumption is different, but the rates are kind of in similar range, and we want to drop rates by those cents, approximately again in that realm. And by doing that, we are actually dividing the pot of money we talked about in the earlier slide. Like roughly we have in the rate relief tools up to 200 million. So we kind of divvying up the money equally across all rate groups.
That was clear, Kyle. Thank you. I appreciate the answer.
And then the director said,
Yeah, so my understanding is the PCIA is going up because the PUC determined that PG&E undercharged in the previous year. Is that correct?
So they did a retroactive rate making. CPUC allowed for a retroactive rate making. So they were, just to step back, so PCIA was set on a certain rules, until 2025. So PG&E went to CPUC complaining that the value the PCIA customers are getting way higher than they should. And based on that, there was a PCIA reform track which happened at CPUC, and they changed the way, especially resource adequacy is computed. We dropped down the price roughly from $40 per kilowatt month to $10 per kilowatt month. So that calculation change led to under recovery of $2 billion. So quite a bit of money, just because of that, simple math change. And what's really hurtful is changing the rules for 2025. It could have been like from 2026, then we would have been in a different set of environment. But because CPUC allowed for a retroactive rate making, meaning for 2025, they said, yeah, instead of collecting 40, instead of collecting 10, you collected 40. From ERA customers are under recovered from, our PCIA customers. So basically they had to charge their customers more, and hence they had to give that money back by getting that money from departed customers. So that retroactive rate making is from 2025, because they can't collect from 2025 anymore. So they are kind of tagging into 2026. So there is that double impact. The value of portfolio is going down, but they also allowed for a 2025 correction to be collected in 2026. So that's the impact we're seeing in 2026. If that makes sense, yeah.
Yeah, so either whatever option we go with, customers are gonna see a higher overall bill, correct? And how has the staff thought about how they're gonna communicate that to customers, whatever option we go with?
In the customer messaging, I don't know, Jamie, you want to take on that one?
So, I mean, are you saying how are we going to communicate the differentiation in the PCIA or in
Yeah.
what the
Yes.
overall? So, I'm not sure that we have a specific plan to reach out to all of the customers about the PCIA. We speak to them as they call in. In fact, we had a conversation this morning with a customer about the PCIA and explaining to them that it is a balancing account. What happened with that account this last year, as Cal just explained, that there was under collection and therefore all of the collection is happening in this year, and that will balance back next year. And at the same time, it's going to balance back for PG&E. So the forecasts right now say that the -1 cent per kilowatt hour that the PG&E customers are receiving in credit for this year will actually bounce back to 1.4 to 1.7 cents of cost next year. So they're going to see almost a 2.5 cent change in increase.
Thank you.
Certainly.
Director Sabetta, did you have any questions?
Yeah, I'm trying to wrap my head around what Zay just said. If we were to leave the rates as is, if we're expecting PG&E to increase their rate next year, would ours kind of just balance out? Or do we have an opportunity to lower ours next year versus this year? So that way we're better compared?
Can you repeat that question, Director? Sorry, got sidetracked.
Yeah, so I'm trying to figure out, I don't know if it makes sense or not, but so, because I'm trying to figure out all the numbers.
Mhm.
So what Zay just said was that PG&E is, this year was under collecting by 0.1 cent, right?
No,
And next year,
I'm
it's
sorry.
gonna go up by 1 point something.
So,
And we're,
sorry, go ahead. Go ahead.
sorry, then we're trying to make up that difference this year.
Not
So-
really. Yeah, go ahead, Zay.
So let me clarify a little bit. So the PCIA is a balancing account. PG&E sees what the overall costs are, those contracts. They take that amount plus the revenue and they say, okay, here's the leftover amount that we need to charge for PCIA. They under collected in that account, which means that they didn't charge CCA customers at the level that they should have for the last 2 years, and inherently overcharged bundled customers because of that imbalance. The CPUC, after hearing from PG&E, allowed them to collect on those funds that they did not appropriate last year and for them to collect them this year, which means that we have what we expected to be our PCIA plus this additional under collection on top of it. So we have a larger amount that we have to pay this year. They in turn are charging their bundled customers the lesser amount from what they overcharged them prior. So if you take those two and you put them on a seesaw, then they're balanced there. But what's happening to our customers is imbalanced. And next year, that balance is going to change back where they are no longer going to have a credit in their side of the balance sheet and they're going to need to pay again. And we will normalize back to the level at which we should be on a regular basis. Does that help a little bit?
I think so, yeah. Yeah, okay. Thank you. Thank you. No other questions for now. Thank you so much for that great explanation there.
Certainly.
Awesome. Let's keep it rolling.
Yeah, thank you guys. Next slide, please. So this one talks about, I think, reduced clean energy procurement scenarios. We went in detail, I think, in the budget workshop. In the interest of time, just to at a high level, I think what we are showing here is we have several scenarios. We can utilize. One is the status quo. It's all about RPS and carbon-free targets. What are our goals currently, which is 60 to 65% RPS and carbon-free 95%. So if you take a scenario one, this is where we are. That's a status quo. But 26, 27, we have roughly 643 million cost of energy. Obviously, no cost reduction. But if you go down the scale into scenario 7, that's a spectrum of scenarios, but really the bookends. Scenario 7, if we were to drop our MCE higher targets, which we have set to state mandated bare minimum compliance requirements, then our RPS drops down from 65% to 45% in scenario 7, where we utilize RPS banking or whatnot, which has impacts to our power content label as well. And the carbon free would be roughly 70%. So in that scenario, the bottom scenario, I think we could unlock up to 17 million based on current estimates of market prices. So not a lot, but for 17 million seems like we would be giving up quite a bit on our power content label and also dropping below our current targets from 60, 65 to 45%. I'll pause there to take any quick questions on this one.
Not looking like any from Concord. Director Zabeta?
No, I'm good. Thank you.
Right.
All right, moving on to the next slide. Next slide, please. Yeah, thank you. Again, we looked at reductions. I think this slide goes into, again, taking residential rate as a snapshot. What our proposed generation rate reduction options look like by taking into reductions as well. So have 2025 in here as reference. Green bars are MCE generation rates and blue bars are PG&E generation rates, and everything is in cents per kilowatt hour. See, in 2025, purely looking at generation rates, we are at 14.62, much lower than PG&E 17.29. Coming to 2026, the PG&E generation rates dropping to 12.57. I think that's part of, over collection from their customers. You can see that impact here. If you look at MCE generation rates in 2026, we are currently at 14.62. Obviously, there is that difference between PG&E goes by calendar year and we go by financial year or fiscal year from April to March. So obviously our rates are still trailing because we are still in the current fiscal year. And if you look at those MC current, it is 14.62. And in option 1, it's 12.8 now, 9. And I have a small table at the top which shows options, and each options how much deficit it can runs into if you use that rate option. And if there is a deficit, what is the source we're getting the funds from to kind of make up for that deficit. So it's just kind of a recap of the previous slides into this. So option 1, break-even point, you would be, if you look at rate by itself, slightly higher than PG&E's 12.57. So we would be at 12.89. So option 2 is really the rate at which we get into parity with PG&E. Our rates would be 12.57, matches with PG&E's. That would be a little bit over 2 cents. Again, runs a deficit of 17 million, and we tap into ORF in that instance. So similarly, in option 3, 4, 5, and 5 being the biggest drop of 4 cents, we would be roughly 2 cents lower than PG&E in that instance. Right.
So Cal, just with this one, I just want to clarify. I think this is what you're saying here with the source on option 2. It's not ORF plus reserve. It's just the ORF.
That is correct. Yeah, that is
that
correct.
you've included. Okay,
Yeah,
gotcha.
yeah.
And then I guess this is just probably from a council member's perspective. When we say deficit, we don't mean a structural deficit. What we're just saying is 1 year we've been using something that has been accounted for expense. Maybe we should change that
It's like
verbiage.
cost. something like
Yeah,
that.
it's not a deficit. I wanted to say that at the workshop. I don't think I mean, you're the finance expert, but I'm like, I think the term deficit is a little bit of scary in this moment to hear. It's not, and I don't actually think that's the practice of it. It seems more so like we're utilizing an expense that we've already,
That
we
is
already.
correct. Yeah, yeah. It's purely looking from cost perspective for that year. We are not recovering without the rate, that rate, we would not be recovering 100% of our cost, but we have other mechanisms in place to kind of tap into to get that money from.
I think it's just the
Is
term
there-
deficit.
Yeah, or maybe at least footnote it.
Cost or expense or something like that.
Yes.
I mean, it's all
Outlay, yeah.
Yeah.
Yeah. Or even shortfall if we want to.
Short form, I think it's a good word. Yeah. Yeah. Go ahead.
That's great feedback. Thank you for doing this. We could say that it is below cost of service.
Mhm.
Yeah.
And yeah.
Perfect. Thank you, guys. Any more questions?
Doesn't look like any from Concord. Director Sabeda?
No, nothing for now. Thank you.
Moving on to next slide. Okay, again, this one very similar to previous chart, but adding PCIA on top. And you can see in 2025, PG&E did have a credit on, the orange bars are the PCIA. That's the addition from the previous slide. So if you look at all in generation plus PCIA, even 2025, like we saw in the historical chart, we are slightly higher than PG&E. I think we are at 15.8, but PG&E 15.1. But going back to 2026, after taking PCIA into account, PG&E is roughly 11.5 cents, a little bit over 11.5. And we would be again higher than PG&E in every single option. We have a table at the top showing how much we would be higher by. But option 2, which is, kind of brings generation rate into parity with PG&E. But we do have to contend with that PCIA. In that instance, we would be 4.67 cents higher. We really start making dent into PCIA from option 3, where our generation is lower than PG&E's, but that kind of offsets the credit bundle customers get. I think that was kind of thinking. And then option 4 makes bigger dent into PCIA differential, and then option 5, it drops down to 2.72. Okay, I think we can go to the next slide. Unless there's questions in that. Okay.
I'm just going to do a time check. We're here an hour in. We're supposed to be an hour and a half. I think our goal is to give a recommendation from tech community. I want to make sure we have enough time. I'm just like, I don't know if everybody's seen these slides. We may want to accelerate this just so we can get to the discussion part, which I think is the key part.
Sure.
And we're already 2/3 of the way through our
There's
meeting.
4 more slides.
Okay,
There are-
I just want to
yeah.
make sure we.
Yeah. And I wasn't aware of the hour and a half time frame. Is that what you all discussed last week?
It's what was scheduled for the meeting, that's all.
Last week.
Well,
Right now?
Yeah, that's
Right.
what's
Okay.
scheduled there.
Yeah.
Yeah, sure. I mean,
We're going. I just wanna
It sounds
keep
like we're closing out.
Yeah,
So-
yeah, we're kind of almost coming close. Yeah, I think. Yeah. Next slide, please. Yeah, again, this is the bill comparison. We made updates to what's in the packet already, but we showed in the budget. We updated the delivery rate for 2026. Thanks to our customer operations team. Earlier we did not include conservation, baseline on the delivery rate. Now we have included that, so we can see the updated bill. Again, what we're showing here is in 2026, PG&E customers, bundle customers, what would their average monthly bill be? Typical residential customers, which is $180. So in 2025 for MCE customer, they would have paid $192. The current, what we have right now, I think our MCE customers would be paying $209, so which is $29 more than PG&E, so which is roughly 16% higher. Again, option 1 to 5, you can expand higher in every scenario, But option two, where we have parity on generation, would be roughly higher by $20, around 10 to 11% higher than PG&E. And then option five, which is the bottom end of our options, I think our bill would be still higher by 7 cents, 7% rather. Yeah. The one more point to make here is why customers may not be switching yet by looking at these differences because of TBCC. An average bill, if you look at the spectrum, it can range from 180 to 250 per month, right? So it's very volatile TBCC rate. The customers may be exposed to that much, again, much higher too. So that may be kind of playing into inelasticity of our customers. Okay. Next slide, please. Yeah. Again, quick, we went through again budget workshop. We updated the numbers slightly. Point of this slide to show we have two time snapshots. One is 2013, which are bottom pie charts for MCE and PG&E, and the top pie charts for the 2026 for PG&E and the upcoming 2026 2027 for MCE option 2. So if you see generation rate as a proportion of total bill actually kind of shrinking. So if 2013 T&D is roughly a little bit over 12 cents, but it's more than double to almost 30 cents in 2026. On the generation side, it's a little bit over 7 cents, but it's not like a little bit less than double to 12, roughly around 12.5. The punchline on this slide is the generate T&D, that's where the majority of the bill kind of going towards, and that's where PG&E too obviously has a profit making mechanism, so they are obviously focused on increasing that bits for them. Next slide, please. Okay, yeah. Bringing all in again, one of the lines we maybe thinking about strategically is how's the future looking like? A customer making a choice, want to look how the future rates. And the punchline maybe here is, can a customer looking at it, is it a trend or an anomaly? I think that's why that's how we want to look at it. We think 2026 is an anomaly where PG&E rates are really going down, and we layered different, dash lines are options, option 1 to 5. But 27 to 29 is where the projection is. Looks like PCIA is going to converge across vintages. And if we extend our cost-based rates, again, not saying that those are the rates, but if you just purely looking at our cost, we would be expected to come down, almost come closer in 2027, come down then 27, come down, will be lower than PG&E's in 28 and 29. Again, the other point here is if we were to pick option 3 to 5, we would have to increase the rates later years, but that increase would be offset by lower PCIA. So net, they all converge to one dash line in 27 to 29. But that's a nuance there. Option 1 and 2, those rates are sustainable generation rates. We don't need to go tell customers that we are increasing rates. But in option 3 and 5, we do have to raise our generation rates. So if we pick 3 to 5, it's more a temporary relief for 2026. That's the bottom line. Yeah. To the next slide, please. Okay. I'll hand over to Myra to kind of wrap it up. Thank you all.
Thank you, Cal. So in this slide, we put everything together. We go back to our reserve and liquidity outlook, and we have all the options that Cal laid out, option 1 through 5, and how would they look in our reserve and liquidity perspective. So as I mentioned before, the current fiscal year, the projection is 274 days cash on hand, and option 1 at 290, and down to option 5 at 242. So I also want to touch that the reserve and liquidity goals, they are moving targets. They are percentage of our expenses. So when we unlock and we reduce our power content on option 5, we reduce our expenses. So it becomes easier to hit our goals. And that's why we still have a 244 days cash on hand. So I'll give you a moment to put everything together and reflect into the options, and before we move on to the next slide. And let me know if you have questions in this one.
Maida, I think we should just move on to the next slide and then we'll go back to final questions and then public comment and then
Perfect.
deliberation.
Perfect. Next slide, please. Great. So here's the recommendation for options 1 through 5, and in a summary of all of the options that we have been discussing today. So with that, I'll take questions, and I'm looking forward to your recommendation, and we will take this recommendation to build up budget options for you all for next month.
Fantastic. And thank you again for your presentation and slides. Love the additions. I thought I would be seeing the same slides again, but it was great to see the additions. Do you have any other questions before we, Director Sabeda, any questions?
No, none of this time. Thank you.
All right. I don't see any public comment here in Concord, but I'll ask the clerk if we have any online or in San Rafael.
I see no public comment online and there's nobody here in San Rafael. Thank you.
All right. So we'll bring it back to deliberation. Anyone want to start? Oh,
I'm sorry, if you don't mind. I just want to bring up a couple of things. This morning, it was in the East Bay Times. PG&E had their analyst day, the financial, they were talking about their 2025 performance and outlook. I mean, I'm sure the MCE folks know this, but I just want to pull out a couple of quotes that I think are interesting. The investor-owned utility posted a profit of $2.59 billion in 2025, almost 5% higher than the $2.5 billion profit in 2024. They said electric bills have gone down 4 times since 2024. That's equivalent of about $20 a month for electric users. However, they did say that materials, they expect that monthly bills are expected to be in the range of unchanged to 3% increase during the course of 2026. We are looking at zero bill inflation, PG&E Chief Executive Officer Patricia Poppe said during a conference call with Wall Street analysts. That's a number to be proud of. So right now, PG&E is they're not going to be, they did their rate lowering, whatever they're doing now, they're going to be stable. Right. So it's interesting. So, or up a little bit. I think that's an interesting term, zero bill inflation, which basically is inflation's running about 3%. So they increase it about 3% to be kind of, still feel like it's about flat. So it's interesting, right? That they're kind of status quo.
Yeah.
They're done. We kind of know what they're going to do. And then we can kind of do our bit.
Yeah.
I mean, this is we all heard this, I think, a couple of times, I think the 4th time I've heard it, but it's good. I agree. Every time we hear this thing, it's, I have to admit, I'll just kind of start. I could put on a thing that I just think, as I said, I think when we think about the different reserves is really important, right? I mean, I think we've got the ORF, right, which I think was put in for rate smoothing, which is an great this. But our core reserves, I mean, to me, those feel more like, there's a natural disaster. There's, one of our plants goes offline. There's something, economic collapse. I mean, there's things that we need to be prepared for. This doesn't feel like it warrants that. You get dipping into those, right? I mean, this is, our prices are, we think our customers are fairly inelastic. We're not really at risk of losing a whole lot, probably. So, I mean, I would definitely I'm all for using some or all of the ORF, but I would not feel comfortable going into any sort of other reserves. I guess I would start there, which I think takes out 4 and 5.
Mm-hmm. Absolutely.
I don't know, just as a thought.
Yeah, I would hate to reduce the amount of clean energy content as well.
Yes.
I mean, thinking about my city going through a climate action plan right now, a lot of our projections are based on, the light green clean energy content. So yeah, I think to me, 4 and 5 are definitely out, and potentially 3. And then also seeing that, that participation rate remains the same. I'm kind of going between 1 and 2. So I'd love to hear what other people think about that.
I think that what I'm hearing is that people are kind of at the 2. Well, 1 is kind of just keep it the same, I think, right? Largely.
No. One is we've got we actually got our revenues exceed our expenses by a certain amount. So basically, that's just saying let's just kind of put that back into our rate, the rate formula. So we'll give people discounting, then but I mean, our profit, I mean, we're nonprofit, but excess revenue can be used for other good
Exactly.
things, right? So it's still a bit of a sacrifice for the organization, but no, that's right. So we don't dip into any reserves.
Yeah.
And we get a pretty good jump, and then it's more. What we're doing. So then how much of the ORF do we use?
Yeah, I think so. There was like a sample bill, but I think the sample bill is as average, right? If we do comparisons, because some states are going to be impacted by this more than others. I mean, I'm very clear Hercules is on that list of more than others, and I've received, there aren't valid concern. There are concerns from residents. However, what their concern is over is largely the gas increase because it was cold last month. But they are price sensitive to that, right? And no one that has talked to me has said they're going to switch, but I've had those questions along the way. I understand switching is a complex process too, and I appreciate staff's explanation of that. But back to the question at hand, I'm looking at 2 or 3, but probably 2. I think that my question to staff would be, how do we phrase it? What I don't want to do is lower the rate so that we increase it. We're raising rates, right? I'd rather be more like the messaging, be more like we're doing a credit for the year. I think that I've heard in previous meetings that we expect PG&E's rates to move next year as well, or for everything to balance out. I think Bacon said that at our last
That's
meeting.
right. They said they go like the next every year for the next 3 years, they've got some sort of plan, because they have to.
Yeah, exactly.
One good thing is they have put all their plans on the table with the CPUC, right?
Exactly. So I think that would, I think how we message it, again, I'm looking at, my preference is probably 2 right now, for the reasons that we stated here. But I think just how we, communicate that, I think it should be communicated as a credit so that when it goes away, we aren't raising rates because we'll be dinged for that too, right? We raise rates next year. Well, we stayed on parity, but that's kind of hard to communicate out after the fact. So again, as I'm looking at this, I think 2 is my favorite option. I understand we have to work as a committee to come up with a suggestion, but I like option 2.
Director Zepeda, do you have any thoughts or comments?
Yeah, I'm with 1 and 2 as well. The difference between 1 and 2 from what I see inside 11 is $1 between the 2. And is that going to make that much of a difference one way or the other? So
There's a better slide. Can we go to a better, there's that, I think the slide right at the very beginning actually had all the pieces, including the impact to the customers.
yeah,
That's a great slide. I think that one's very helpful.
Yeah. So here between 1 and 2, the impact, how I see it, right, and correct me if I'm wrong, but option 1 is 22 and option 2 is 21 above. So the difference between the 2 is just $1 above. So if we don't do anything, they're going to be just paying we are going to be paying $1 more above. Versus saving $1, which to some could be a lot, and I'm not discounting that because it's hard times right now. But between 1 and 2,
I think option 1 is still doing something. I think option 1 is still we're still taking the 90 million at play, right? I mean, I was right to be clear, correct? I mean, that still requires a decision, but yeah.
I'm sorry, Director.
Isn't it? Right. Option 1 is still, we're still doing, option 1 is still
Yeah,
significant.
we're dropping our rates to cost-based, which is roughly 90 million we would be giving up. So that's
That's a huge, I think when we message this, there's a tremendous opportunity to kind of say, yeah.
The option 2, good thing about our option 2 is kind of aligns our generation rates with PG&E, right? If you just want, if that comparison ever happens, so we are into parity with PG&E on option 2, just to make that distinction.
And now, just like you all know, I'm generally supportive of option 1, mostly because I kind of have alignment when we were at the workshop around, we've worked to have that operating reserve fund for a few years. So it is something that we've obviously larger reserve, but we've specifically set that reserve policy fund for a bigger emergency. And just being on this board, even during the pandemic, like we were able to do that. And I think we would all agree, like that was a pretty drastic event that happened to our communities. So I feel like I'm more in tune with, I guess the question is like, what is rate relief, right? And a lot of folks obviously want, I think, as as electeds and representatives of our community, we oftentimes see rate relief as, again, a bill and direct, relief from that bill. But I also think there is leverage in this moment, particularly because we are a nonprofit. We have a lot of customer programs that we can still, arguably, we can also just have the status quo, have higher revenues, and then still utilize some of those funds for different programs that, frankly, our staff actually has been exploring over the last couple of years. We just haven't been able to have those conversations in the midst of so many other conversations that are happening. I would love to have that article that you.
Yeah, I can forward it to you. It's really quite interesting.
I would love to read that through because I think that that also that's a piece of strategy that we are again we're seeing this kind of whole picture right as a state and our local agency versus CCAs. You know, for me, I think our staff does such a tremendous job at developing programs that do in some ways provide relief, maybe not direct rate relief, right? And that's it's not seen as that, but a lot of folks benefit from relief through rebates and things that they were going to do anyway, but because we manage those programs, it feels like relief of some sort. So, you know, I number one, first of all, Cal and Maida, this presentation, I just want to say, and Zay and you know, all the team, like this has changed the way even I, as a board member, has seen our work. So I'm super grateful for it. I don't think any of this is in vain at all. I do think that there's value still to even moving forward with, you know, again, I think option one, it makes sense to me because why not? But it also could potentially just be, again, no generation rate reduction, I should say. And that still to me would, given the data that you all have said, especially like our retention data and just the way in which we have operationalized ensuring that residents are still commercial residents are still participating in our service, it doesn't seem like we're in a moment right now yet where this is imperative for us to move on. I'm not saying that that can't change in a year. I'm sure you all have thought about that, right? I mean, again, we don't, last year, this time was so different from this year, this time, when it comes to energy, when it comes to a lot of things. So I think, yeah, I would be, of course, supportive as a committee of supporting one and or two. But I just wanted to note that because seeing this presentation so many times, it makes me sometimes think, okay, maybe we don't need to move on any of these options. Maybe we actually create more leverage of our company and ensure that we have those additional revenue funds. And when they come in, then we can have further conversations that say how we utilize them.
I have to say I was actually in favor of two or two. I was actually thinking of 2.5 myself, which is
2.5.
Yeah, because I think well, here's my thought. The rate, the ORF. This is where I separate the two things. I'm completely agree. The reserves, that's why I said the reserves, which are for all the extraordinary things, we don't touch. Like, so that takes 4 and 5. But the ORF is for rate reduction. I mean, I think it's supposed to smooth this out. And the smoothing we have is because the PCI spike. That's the problem, right? I mean, this is where I think that's the problem, right? That our customers are being stuck with this $20 like surcharge for 1 year before it goes down again. So that's why that's why I was thinking, okay, that is what the ORF was intended for. It just to smooth that out for the customers, so they don't have to absorb. It's hard to explain it. I don't want to explain it. It's hard for us to understand it. But I just think that, so that's where I was actually, I don't mind, to me, using part of the ORF, that's what I was thinking, 2.5% is actually half the ORF if it's 35 million, but regardless. But I actually think it's a legitimate use of that thing. And I hear you on the programs. I like that. What I do like about this though is everybody gets right. Every community member, we can all go back to our city councils, no matter if we're in Belvedere or Lafayette or wherever, and say, MCE we lowered rates or gave credit or whatever, because we're concerned about affordability. And this is supposed to help you, right? I don't know. That's my only. I just want to push a little bit more. I mean, I hear you one or two, but I think that, I mean, to me, I think at least two feels right for communicating. And I go back to what are those principles that we articulate that were improved, which is we're green, so we're not touching our mix, which is really good, right? We're in touch with our community, but we want to be cost competitive. And 2.5 gets us. We can actually say we are right. We're basically right where PG&E is rate wise, forgetting PCIA, and we're greener. And we have customer thing. We get it all. Anyway.
Yeah, I think it's an important point because $21 a month doesn't sound like much, but it's $247 a year. It's an extra bill.
Yeah.
And so our customers are going to get an extra bill, the 13th bill in the month in the year for that amount. So I think lowering it helps with that, right?
It does.
And again, the messaging.
It's a messaging.
And the money, again, I'm not into spending. That's why I asked the clarification earlier about where it was coming from. I'm not into spending our work reserves because that doesn't make any sense. At least to me, it doesn't make sense at this point. But I think that using the money that's there. So we've done this in my community for other services that we provide.
Recycle smart. We're back.
Exactly.
We build up a fund.
Yeah.
And then when we have to jump with the contract changes,
Yeah.
we use it, and that's what it's there for. And we all just like, that's how we collected extra money in the past
Exactly.
to do exactly this thing. This is kind of why I'm like, this is a textbook reason for using ORF, is my thought.
I do think the messaging is important though, because if we go back and we say we've reduced rates or we've kept them below or the same as PG&E, but most customers don't understand the PCIA. I didn't understand it.
Or the
before.
generation rate.
But
They just
understand the- that's what, but yeah,
bill,
correct. I think staff can come with a way of communicating that out to customers, whether it be something that they mail out, because that does go out from time to time, or whether it's just through their social media. I think I've
It's
seen
probably
some
a more is more kind of thing.
Yeah,
Probably.
right. Yeah, and just let people know that this is this. And I think that, staff can decide how to do it, but I think like we did with the credit, we called it for for our recycle stuff, because we did that. I think you guys did the same thing in Pinole. It's a way for the community to see that we're trying to do the best.
We're trying to help. There are things beyond our control, like, the garbage rates go up. Okay, we can't, that's the best we can do. PCIA happens. There's things we can't control, but what we can control, we're going to do our best for you, right? Because we got your back.
I agree.
So at first I was hearing between 1 and 2. Now I'm hearing between 2 and 3.
Well, I'm just saying at least between I feel 2.
Okay,
Right?
2.
He's saying 2.5.
Well, I was just trying to get the part.
I know.
And Director Zepeda, jump in here. I'm hearing 2 now. Yeah, I'm hearing option 2 is kind of our option 2 for the generation rate reduction plans is where we're landing. Director Zepeda, did you have any differentiation or consideration?
I would go with option 2 as well. I think that the points made are really good points.
All right. Anyone want to make a motion?
I make a motion that this committee recommends to the full board that they move forward with option 2 on the rate reduction plan.
I will second.
Any further discussion or questions? If not, we'll go take it to the vote.
The suspense is building.
It's going to be
It's coming.
I think that you're
Can you hear us?
Yeah, we can hear you. And there is no public comment.
Oh, we already went there though. So feel free to call the vote.
Hercules,
Aye.
Lafayette.
Aye.
Pinole,
Aye.
Pleasant Hill. Was that a yes?
I'm sorry.
Thank you. Richmond,
Yes.
motion carries.
That was a tight race there.
Even though it's not going
It
up, I
doesn't
guess.
show up on the screen.
That's kind of weird.
Oh,
Only the absent shows up.
I wonder if there's a bit of a lag.
No, because we saw the little thingy go. Anyway, it doesn't matter.
Yeah.
I think we're.
We were just,
I'm sure you guys will figure it out.
Jessica, we were just,
Put it up here.
oh, there it is.
There was a bit of a lag there, but now it's showing up.
All right, well, this committee will now recommend this to the full board through the budget process, which is already starting. So thank you all for participating. It sounds like that's the only action we're going to take on this item unless anyone has any other motions to make. All right, then that brings us to our next item, which is committee and staff matters. Any additional comments or questions, any thoughts? And if not, we'll adjourn this meeting sounds like none. We'll adjourn this meeting at 11:23. Thank you all.
Aye.
All right.
Thank you.
Bye. Happy
Bye.
Friday.
Right, thank you.
Thank you all so much.